Let's begin. Let's begin. We have Makisha, we have Tainik. So welcome. So let's begin to talk about today's topic. But before we proceed, I would still like to clarify uh, an important question, which is that um, you will no longer be given problem-solving assignments on MyLab, but you need to do all the quizzes in MyLab. Do all the quizzes in MyLab. No more homework problems, that is written problems in MyLab. If you have done them up to chapter 9, that's fine. Chapter 10, 11, 12, 13, and 14, you don't have to do anything anymore. I will assign them on Blackboard. And so you have to solve the problems on Blackboard. Having said that, today we are going to be talking about the valuation of stock, common stock. Last time we did the valuation of bonds. I did not give a lecture. I just wanted to clarify things for the class. So for today, we're going to do the valuation of stock, which is the valuation of common stock. And essentially, the same principles apply to the valuation of preferred stock, except that preferred stock does not grow. The dividend in preferred stock does not grow. So let's begin. I'm going to share my screen and go through some PowerPoint slides, and then I'm going to do some examples. We're going to look at some examples. Then I will illustrate. The homework problem and show you how to do it. So let's begin. I'm going to share my screen. Okay, so I will go to the screen. This lecture is adapted from the book by Lawrence Gitman. Okay. So, I mean, the key differences, like I said, last time we talked about, or the last week, the lesson was about evaluation of debt. Okay. Now we're going to do evaluation of stock. The key difference is that in debt, the bondholders do not have a say in management of the company. The equity holders do. In the event of liquidation, the bondholders, those who hold debt, will have the first claim to the liquidated assets of the company, and equity holders are subordinated to debt, to the debt holders. The maturity time of debt is clearly stated. Can be 5 years, can be 10 years, can be 15, can be 20 years or more. There is no maturity time for equity, which is to say, once you invest in equity, you are in it forever. In tax treatment, the company can deduct the interest paid on tax, and the dividends that are paid are residual, and so they are not deductible for determination of profit. As a matter of fact, the dividends that are paid is after taxes are paid, then the dividends are paid. All right. And of course, the stockholders have voting rights that we know. Bondholders and preferred stockholders do not have any voting rights, which again goes to saying that that is why they have no say in the management of the company. Now, I will move quickly to get to where we talk about valuation. Now, remember that when we talked about the valuation of debt, or when you read about the valuation of debt, the value of debt depends on the face value of the interest that is paid on debt, and you use a discounted value method. And it also depends on the horizon, the time horizon. If debt is 10 years, 11 years, 12, 15, 20 years, but also on the current and prevailing rate of interest in the market. Okay. All right. Stocks are sold based on par values, but then usually the market price of the stock is not its par value. Market price of the stock is determined by the expected or the desired rate of return of the holders of common stock. Okay. So if you look at the balance sheet of the company, there are authorized shares, which is the number of shares that a company can sell based on their charter. There are outstanding shares, which is the number of shares that are already sold and held by the public. So the outstanding shares could be less than the authorized shares. You have treasury stock, which actually is sometimes the board of directors will buy back some shares from those that um, those that hold those shares. You buy them back, and that's called treasury stock. Okay, so here's an example of a balance sheet. Okay. Now, again, you have preferred stocks, which is some kind of equity. But preferred stocks, what happens is that preferred stocks, they receive their dividend before common stockholders receive anything. Okay. Now, sometimes a company is not able to pay the dividend on preferred stock, and then they could become cumulative, so that if dividend is not paid this year, then the next period, all the arrears of dividends for preferred stock must be paid before common stock can receive any um, any dividends. Okay. Let me again move fast so we can talk about evaluation, which is really where okay, we have expected return, and expected return is calculated in a number of ways. I will touch on those when we begin to calculate, when we begin to discuss capital budget. Okay. So if, as an investor, you receive, you invest in a common stock, your expected return depends on the dividend. And so I'm going to see if I can modify the way this is so that you can understand it better. Okay, let's see. So the expected return equal to, so I'm going to use a normal equation. Okay, the dividend is a price plus expected growth. So ordinarily, um, dividend is the current dividend, and the price is the price of the stock plus the expected rate of growth of the stock. Okay, so in that case, what you have is that the companies reinvest some of their profit. And so if they have a return of say 20% and they reinvest 80% of it, then the dividends, the profits that are not distributed become a factor in the rate of growth. So a company that has a 20% return on equity and invest 80% of their shares will have something like a 16% rate of growth. Okay, and we're going to calculate that in an example. Okay. Now, the price of a stock depends on the discounted value of all future dividends to infinity, which we're not going to use this formula, but conceptually, this is what it is. Okay. Uh, the price of the stock at any point in time is the expected dividends over time. So D1, D2 on to D forever. And then RS is the required rate of return on the common stock. So as a shareholder, what will motivate you to invest in a share? Okay. So now there are two ways to value a stock. Okay. You can assume a zero growth in dividends. So the dividends will be the same forever. Okay. It will not grow. Or you can have a dividend that grows. So we're going to look at two examples here. Okay. So in a sense, if you assume a zero growth in dividends, then the price of a stock, which I'm going to illustrate here. Okay. So going to so the price of a stock at any time, okay, is going to be, and I'm trying to illustrate what they have here. Okay, is going to be D over R, where R is the dividend, the required rate of return. But then we talk about if it's a zero growth stock, then this dividend will not grow. Okay, so for example, if D is equal to $3 per share forever, and investors require 12% rate of return, That means then that the price of the asset will be three divided by 0.12, which is the required rate of return. And so what does that give us? That will be $25. Okay, 3 divided by 0.12 gives you $25. So you assume that this $3 dividend will be the same forever. It will not grow, it will not change. It will just always be the same. Okay, so and we can move very quickly from that to, okay, that's an example there. Now, but suppose that we are looking at a company whose stock will grow. Okay, so let us see how we value such a company. Okay, we're going to see how we value such a company. Again, the price is based on this formula, which we are not prepared to work with. The price is this formula here that you see, that is the current dividend times 1 plus G divided by 1 over RS to the power 1 and to the power 2 forever. If you solve it mathematically, it will give you the price that you see here below. So I'm going to write that new price down. Okay. Okay. All right. So the price should be, and I'm going to and I could actually just use plain P. Okay. The current dividend times 1 plus G divided by R minus G. All right. So that gives us the formula that we are looking for. And R is equal to required rate of return, and G is growth. All right. And D naught, okay, is current dividend. Okay. Current dividend in the sense that this is the dividend that is being paid now. Now, that dividend is expected to grow, okay? On the condition, on the condition that R is greater than G, okay? If R is greater than G, then the formula becomes more complicated and we don't deal with that formula at this level, okay? So let us now look at an example, okay? An example let us say current dividend is current dividend of $2.50. Expected growth equals to say 5%, that is 0.05, and required return is equal to 7.8%, okay, which is 0.078. So what will be the selling price of this asset? Okay, what is the selling price? So question is, what will be selling price for this kind of stock? It's very simple. You can solve through it. Okay. Let us see if we can solve through this. We take the formula here. Okay. And so the current dividend is $2.50, so 2.5. And the growth rate is 0.05. And R, the required return, is 0.078. And of course, minus G, 0.05. So what do we have? What we have is 2.5 times, so there's an equation there. So what we have is 2.5 times 1.05, 2.5 times 1.05, 2.625, 2.625, and 0.078 minus 0.05, 0.078 minus 0.05 is 0.028 divided by 0.028. And so what we have as the selling price of the asset would be 93.75. 93.75. All right. So this is an example of solving for the price of a stock. Okay. Now, how would you calculate growth rates? Okay, so I'm going to use this example to calculate growth rates. I didn't I'm going to take this out because this growth rate is not exactly 7%. It's something close to it. So we're going to calculate the growth rate here for this particular asset. Okay. We're going to also, so let us say we look at this here and calculate the growth rate. Okay. I have a calculation of the growth rate of the asset. Calculate growth rate and value stock. Okay. Okay. So this is the same data that you have. Same data that we have, except that now what I did was to look at an average growth rate. So we're going to use the average growth rate of 2. So we're going to use an average growth rate of 6.97. So that's exactly 7%. And, it's about the same thing. But I just want to give you an idea how to calculate your growth rate much more accurately. And again, the author simply referred you to a table. But what if you use the method that I use, which is the growth rate here is calculated as, and I'm going to give you an idea how to calculate growth rate. Okay, how to calculate growth rate. So I took an average here. How did I calculate that? Okay. G equal to the way I did that. Is D1 minus
Professor,
yep.
I have to leave the Zoom call at 7:30. Will this be recorded and posted?
I'm going to record it and post it.
Okay, all right. Thank you so much.
All right. All right. So this is essentially what I do is I take the current dividend, subtract the previous dividend, and divide by the previous dividend. So that gives you a growth rate. Okay. So now for here we have the growth equals 6.97%. Okay. let's assume that D, the current dividend, equal to, say, $4, and the required rate of return by investors, I call it RS, equal to 8.3%. All right. And so, and our G, as we calculated it, equal to 6.97. So what is the value of the common stock? The value of the common stock will then be calculated using our formula. And I'm going to take the formula from here. All right. Our D naught is $4, and the growth rate is 0.0697, and our required return is, okay, like I said, is 8.8%. Okay, growth rate is 6.97%. So required rate of return is 8.8%, 0.088, excuse me, and our growth is 0.0697. All right, so what do we have? What we have is is 0.088, 4 times 1.0697 is 4.2788, 4.2788 divided by 0.088 minus 0.0697 is 0.0183. And so what do we have? Times 4.2788. So we have 233.81. So that will be the price of the stock. All right. So now I'm going to look at your homework and solve one of them so that you can do the rest. Okay, so I'm going to take the homework example. All right. There is the example from your homework. Okay. Now, how do you evaluate this company? Okay. Right now, you have a dividend of $2.3 per share, $2.30 per share. Okay. And there's a return on equity, the ROE, of 20%. Now, remember that this return on equity is the profitability of the investment. Okay, the return on equity is the profitability of the investment. Now, if the company does not pay any dividend and the investment earned a 20% return, then the rate of growth will be 20% because the company has made profit that is equal to 20% of its equity. And so if the company does not pay any dividend, then the company will grow by 20%. But in this case, the retention rate of the company is 25%. Okay? So in that case, the growth will be equal to 25% of this 20%, which is 0.025 times 0.02. Sorry, 0.25, not 0.025, 0.25 times 0.20, which is 0.05. So this is a 5% growth, okay? This is a 5% growth. Take note of how we calculated this growth, okay? You didn't have like a history of the company, but you expect that this particular growth will continue into the future. And so we're going to, this is how we value the stock. So now, what will be the price that you are willing to pay for the stock? The market is currently selling it for $33. The question is, are you willing to buy it for this? Okay. Now, we expect that if sufficient investors continue to buy the share for $33, that means that they anticipate their required rate of return is going to be changed. But let us say that investors require a 15%. So that means that the expected rate of return, okay, the expected R, which we have in calling RS, okay, is equal to 0.15. All right, so make a note of that. That is the expected rate of return, is 15%. And so now we're going to go and take our formula from here. And go over there and put it in. Okay. So what do we have? What we have is D naught, which is $2.30, 2.30, and G is 0.05, and R 0.15, and the growth is, as we know, is 0.05. Okay, and so what do we have? What we have is 2.3 is 2.415 divided by 0.10. 0.15 minus 0.05 is 0.10, which is
24.15.
$24.15. Thank you so much for helping out. So that is the price of the stock. That is what your homework assignment looks like, and that I expect you to apply what we just said or what we just illustrated to the remainder of the assignment. I've extended the assignment to May 8th. And so you should be able to do the homework assignment that is given to you.
This is week 10's homework assignment?
Well, whatever the latest, yeah, week 10 or whatever that we called it. Okay. I sent the email to the class. I sent a message, and I'm going to resend it today. When I post this, I will actually post this lecture, the PowerPoint and the video, into the week's lecture. Okay. So, do you have any questions right now?
No, so far so good. But I'll be leaving now. I just wanted to see how you was gonna how to solve this one before I left.
Okay, that's it. That's it. I'm done.
Okay, thank you so much. All right.
All right. Anybody else has questions? Okay, so
No.
okay, all right, that's it. That's it for tonight. So
Okay.
please try to do your homework assignments. I'm going to post the video as well as the PowerPoint slides. All right.
Okay, because the previous email you sent out, the link wasn't attached. Even though the bottom says please follow the link, there was no link there.
Or then somebody should have sent me an email. All right, somebody should have sent me an email. All right, so I'm gonna this time I'm gonna post the link. Okay.
Okay,
All
thank
right.
you.
All right, thank you, Professor. Good night.
Good night.